Alright, guys, today I'm going to recommend three pandemic affected stocks on the ASX that are still impacted by the pandemic and have not recovered to their January highs. So, first and foremost, I want to say that I have a position in all three of these stocks and it's almost $200,000. Now, they have more things in common than just me owning them. They all pay a dividend, they were all impacted by the pandemic. None of them had to raise any capital throughout the pandemic. So I don't know about you guys, but a lot of my holdings had to raise capital like National Bank, Sydney Airport, Z Energy, Vicinity Centres. And it wasn't to raise capital for expansion or acquisitions, it was raising capital to shore up the balance sheets. So last but not least, they all have a 30% or higher upside in my opinion. So if you want to learn about these three stocks, then stay tuned. So before we start, I'm going to state the obvious. I am not a financial advisor and this video is not financial advice. I'm just some guy on the internet. I'm not qualified to give any advice, but I'm just giving my opinions and my thoughts. You really have to do your own research and come to your own conclusions. Only invest what you can afford to lose. So with that out of the way, let's get into it. So the first stock is SCG, Century Group, who own Westfield, the largest and most successful shopping mall chain in Australia and New Zealand. Like most retail REITs from around the world, SCG tanked big time back in March and has been kept down by the pandemic ever since. Despite the share price, I've heard from friends and family throughout Australia and New Zealand that their Westfield shopping malls have been quite busy. I started buying SCG at around $1.80 and have invested a total of $115,000 into it. My position is currently valued at $155,000 with 35% gains or $40,000 in unrealized gains. Despite e-commerce growing, I still like SCG and here's why. So the first point is going to be the potential upside. The 52-week high is $4.08. So if you take the high point from January to today, we are looking at a 30% potential upside. Now, it doesn't mean that we will get back to this price ever, but historically, SCG has always traded above $4. Very rarely has it dipped below. So even with the growing, e-commerce and whatnot, I think we still have a potential to see a recovery of a price, closer to that $4 mark. Now, it would have been better to buy SCG on the dip or before it, it spiked on the Pfizer vaccine news. But I still see this as a good buying opportunity. And if my position wasn't already so large, I would still be buying. But I already have a full position, so I'm not adding to it. So the second thing that I want to talk about is Century Group's performance throughout the pandemic, namely the rental collections and the foot traffic. So as you can see here for the gross rent cash collections, in a normal pre-pandemic times, they're collecting about 94%. And then this dipped big time throughout the lockdowns and the crisis. But ever since June, they've been collecting 80% of the rent, and then it's going up ever since. So we're probably at a stage now where SCG is collecting the same amount of rent as they were pre-pandemic. And the other thing is the foot traffic and visitors to the shopping malls. So it's quite comparable to 2019. So if we look here, customer visits during the September 2020 quarter were 90% of the same time last year across the portfolio, excluding Victoria, which Victoria was in lockdown at this time, and it no longer is. Portfolio occupancy was 98.4% at the end of September 2020, so they don't have too many vacant, stores. And just the general performance of SCG and their Westfield shopping malls throughout the pandemic has been top notch. Alright, so the third point that I want to make is about the net tangible assets. So currently, SCG is trading at a discount to the net tangible assets. So the current NTA is $3.66. Last year, it was $4.46. Now, the reason why this has changed substantially is because of the write-down of assets due to the pandemic. But even at $3.66, the stock price of $2.82 is still a discount on the net tangible assets. So what this means is SCG is currently trading under its actual real value based on the net tangible assets. All right, so the fourth one is about the dividend. So They haven't paid a dividend since February of this year, suspending the August dividend because of the pandemic. But I would expect with the current rental collection that they should be announcing a dividend for February within the next few weeks, or maybe next month. So I believe that if they pay a dividend for February next year, as soon as they announce that, people will start coming back onto the stock and the stock price will jump another leg up. So there you have it. Those were my 4 main points for SEG and why I like it. So SEG is not without risk. So if one of the anchor stores or a few of the anchor stores go out of business due to rising e-commerce, then there's a lot of square meters that SEG will have to fill. But Australia is not in a position like America where you buy something on Amazon and get it delivered the same day. Also, SEG is moving towards lifestyle living type situations where people are visiting SEG malls, Westfield shopping malls, to have lunch, have dinner, go to a bar, go to a cafe. People still need to do their grocery shopping, and people like to go out to the shopping mall for something to do. So I don't see the death of retail happening in Australia anytime soon. And what you have to realize too is in America, they built thousands and thousands of shopping malls, whereas in Australia, there are a lot of malls, but they're nowhere near as predominant as they are in the US. And I believe at this price point, with the future of 8% or more dividends, it's only going to take a few quarters of positive reports of foot traffic and rental collections and announcing of reinstatement of the dividend, and the price will go back to pre-COVID times, in my opinion. So let me know what you think about SEG, and I'm going to move on to the next one. All right, that took a while, so I'm going to try and blast through these next 2. So the second on my list is ORG, Origin Energy. I bought 3,000 shares back in October at $4.36 for a total cost of $13,000. And my position is now valued at $15,210 with 16% gain, or about $2,139 in unrealized gains. I'm actively looking to add more Origin if there's any significant dips. So Origin is quite a diversified energy company. They are involved in a number of things, but mainly it's the generation and sale of electricity, and also the production and sale of liquefied natural gas, LNG. So like most energy companies, Origin has been impacted quite a lot by this pandemic. The first being the electricity demand, and you can see here in their quarterly report for September just how much of a dip the demand has been. So this light blue line is small businesses, and you can just see what in its peak in April, the dip was 25% versus 2019. Now that's not just the only thing. If we look at the LNG costs, for this quarter they got $5.81, whereas the same quarter in 2019 they had $9.67, which is a 40% decrease in what they've been able to sell their LNG for. Starting with the first point, why I like Origin. Well, just like SEG, it took a big dip in March, crashing down 56%. But if we look at the January highs and compare it to the price today, we are still down over 42%. Now, past performance is not an indicator of future performance, but you have to imagine when the LNG prices return to normal and energy usage returns to normal, it should mean good things for the stock price. So it's not guaranteed, but I still see it as a potential upside of 42%. Okay, number 2 is Origin's financial performance and outlook. So looking at page 13 of their 2020 investor briefing, you can see that they have a free cash flow of $1.6 billion, which is a 7% increase compared to 2019. They also have reduced their debt by $773 million compared to June 2019, and they have upgraded their integrated gas guidance for 2021. So quite a few positives. Everything else is quite good too. So like the underlying profits are stable compared to 2019. Dividend payout is going to be 30 to 50% of the free cash flow. So plenty of positives. All right, so the next point is like SEG, they have an upcoming dividend in March, and that should help push the share price even further. Origin's very committed to their dividend payments, so they've committed 30 to 50% of free cash flow for dividends, and the projected dividend yield is 5.6%, so not bad at all. So not the most exciting company. It's not going to make you rich, but I'd rather have my money parked in Origin than sitting in the bank depreciating every year due to inflation. So with a potential 20, 30%, 40% upside and a 5% dividend on top of that, I think it's a relatively safe bet. Everyone needs electricity, and I believe LNG is here to stay for the foreseeable future. So I'll be looking for any dips to add more to my position, and I'm happy that I bought back in October. I only wish that I bought more, but I think there's still plenty of upside. So on down days like today, it could be a good opportunity to enter. Alright, I've saved the best for last or the worst, depending on your outlook, and that is WPL, Woodside Petroleum. Now, before I get into Woodside Petroleum, let me just give you my position. So, I've currently got about $300,000 invested in various oil and gas companies throughout the world. This includes pipelines, midstreams, upstreams, downstreams, producers, explorers. It's not often an industry crashes where you get the opportunity to buy and, have the potential to make, decent money out of it. And let me just tell you, I've invested $300,000, but I've already made significant gains. One of the companies I've made a lot of gains on is I bought Shell in October, and I've already made about 50% gain on that. I bought Vermilion Energy in Canada, and I've made 70% gains on that. I've made gains on pipelines. I mean, it's just free money, in my opinion. So, whether or not I'll hold oil for a long time is to be determined. But, within the next several years, the demand for oil is going to go down, but perhaps the oil price goes up. Who knows? So, we need to take advantage of the opportunities that we're given. And right now, there is a big opportunity in oil and gas, regardless or not, if you want to hold it long term. So, Woodside Petroleum, I bought 1,200 shares back in April for $18.37 a share for a total cost of $22,000. Currently, I'm up 23% and I have unrealized gains of about $5,200. Again, let's start by looking at the chart. So currently, the stock price is $22.73. If we take the highest point from January to now, the stock price is still down 37.11%. As I mentioned before, past performance is not an indicator of future success, but if the oil prices return to normal and consumption goes back to normal, you have to imagine Woodside Petroleum's income will raise, and that will also raise the share price. So I still see plenty of upside in Woodside if you wanted to enter a position today. So Woodside Petroleum has performed quite well throughout the pandemic in terms of their production. They're actually up 2% compared to Q3 2019. However, it's the sales revenue that has decreased the most. So down compared to the previous quarter and down a massive 42% from Q3 2019. And a big part of that is due to the price of oil and LNG. So just like Origin, they've been affected grossly because of the price of these commodities. So LNG, you can see here in Q3 2020, it was only $23, when in 2019, it was $50. For oil, back in Q3 2019, it was $66, but in Q3 2020, it was only $45. So we should expect when these commodity prices increase, Woodside Petroleum's revenue will increase, and that should translate to a higher share price. So right now, a lot of energy producers, oil and gas in particular, are focusing on climate change and becoming more greener, cleaner companies, which I think is a positive. And Woodside Petroleum is no different. And in their investor briefing, they've outlined quite a few things of what they're doing and where they believe, gas is going in the future. And so they believe that LNG demand will grow in a Paris compliant world. And they're already taking steps to prepare for this shift in energy and to become, net zero emissions by 2050 or sooner. And some of these steps include planting 44 million trees since 2008. And they're also taking other steps to, to get there. Now, one of the benefits of them doing this is not just for the noble cause of green and clean and climate change, but it's also, there are a lot of funds and ETFs out there now that are not, they're only investing in what they deem as ethical investments. And so for a lot of these funds, a few of them have started to stop investing in oil and gas because they deem it as not ethical. So by these companies taking a proactive step into planting trees and reducing their emissions, and you've got companies like BP and Shell that have wind farms and solar, and they're investing into renewables. So it's a positive, and it might be too little too late, but at least these companies are doing something to try and change the perspective of the oil and gas industry, and hopefully they can meet their emission targets and become net zero by 2050. So it's getting pretty late here and this video is dragging on and I want to go to bed, so let me just bang out these last few points. So Woodside Petroleum, they've got a strong balance sheet and great assets, and that's evident in the fact that they did not have to raise any capital throughout this pandemic despite oil going negative. They have a great dividend, one of the highest paying for their industry in Australia. And overall, I think there's plenty of upside with the dividend and the current share price. So if I didn't already have a position and positions in many other oil companies, I would seriously consider taking a position in Woodside Petroleum today. Alright, that's the end of the video, guys. If you made it this far, thanks for watching. And let me know what you think. Do you have any better ideas? These free companies, they're not going to make you rich, but they're pretty safe options in my opinion, and pretty good upside. And I think the upside could be had within 3 to 6 months easy. Plus, while you wait, you get a dividend on top. So if you do choose to buy it, make sure you do your own research. And I could be wrong, but good luck. And if you liked the video, please like, subscribe, comment, all that good stuff. And see you in the next one.